is we're trying to position ourselves to benefit from the next big position that China wants to put themselves in.
Selling for about the same price with the potential to hand you a gain of 1,587%.
This is Larry Edelson, welcoming you to the first episode in our series, 3 Shocking Forecasts for 2016. Now, my special guests today are 2 superstars of Wall Street, Lien and Boris Schlossberg. In today's program, Boris and Kathy will unveil their forecasts for my part of the world, the Far East. Welcome, Kathy. Welcome, Boris. It's great to have you here today.
Great to be with you, Larry.
Great to be here.
Wonderful. So, 3 shocking forecasts. Tell me about forecast number 1.
Well, first and foremost, in terms of our general outlook for the economy, we think that the markets are headed lower. And there's one trade that we're watching very carefully. The rest of the market hasn't really discovered, and that's the New Zealand dollar. The reason why New Zealand dollar is so attractive is because we believe terrorism and China's economic crash will explode New Zealand's economy, creating massive profit opportunities. Now, this is not what the rest of the market is doing or thinking about, because the New Zealand dollar has been falling in lockstep with China's market meltdown. But the lower falls, the better the opportunity it is for us to get in. The new year started with crushing losses in the financial markets. And mark my words, the selling will only intensify in the months to come. So it's time to consider new places and instruments to park your money. And we think there's no better opportunity than the New Zealand dollar. Why? Because geographically, New Zealand is as remote as you can get. It's a tiny Anglo-Saxon economy that is rich in resources, with what we believe is becoming increasingly rare, a stable economy and a political system that is relatively stable as well. And what I love about it the most is that it has extremely low risk of terrorism. Well, Boris and I are currency traders, and what we particularly like about the way the New Zealand government is run is that the Prime Minister is actually a currency trader in his former life. So in terms of monetary policy, fiscal policy, he knows the importance of currency policy. Now, New Zealand is very rich in natural resources, and you may know that New Zealand provides significant amount of natural resources to China, but they also sell to Russia. Back in August, Russia extended its food ban on many Western nations. But New Zealand was the only country that escaped the ban because Russia was desperate to meet the country's shortages of milk products. And that is New Zealand's most valuable export, which is milk. And it's one of those exports that the world cannot live without. So even though Russia may be kind of in a difficult situation with many parts of the world, they're still importing from New Zealand. And I think that benefits New Zealand's economy at a time when China's economic rotation, which we'll talk about later, is also going to provide long-term support for New Zealand's economy.
Well, I don't think I could agree with you more. My wife and myself were in New Zealand last year. We loved the country, its people, its products. It's politically stable. It's run by a former Forex trader, which is always a good thing. So I don't think I could disagree with you on any count there, Kathy. Tell me now about forecast number 2, if you will.
Now, Larry, forecast number 2 is really interesting because we think that at the same time as the New Zealand dollar is going to soar, the Swiss franc is going to sink like a stone, amplifying our profit opportunity. We like the idea of buying the New Zealand dollar versus the Swiss franc because there's more trouble in the Eurozone to come, and that's going to mean much, much more pain for Switzerland.
Yes, indeed.
Yes, the weakness of the euro puts great pressure on the Swiss franc. For example, if terrorist attacks intensify, it's likely that more investors are going to convert their money into francs. And this is exactly what S&P has been trying to avoid for years. They won't be able to credibly introduce another euro-Swiss peg, but they can intensify their war on cash. They can punish savers very badly by charging even more money to park money in the banks. So that means, for example, they could take the rates further into negative territory, breaking the key 1% barrier. Just to give you an idea what that means psychologically, imagine you'd put 1,000 francs into the bank on January 1st. by December 31st, all you have, even if you didn't take a single franc out of your bank account, is 990 francs left. It's like the government stealing your money, and that is definitely going to drive the value of the franc lower as the year progresses.
Yeah, and also, Switzerland has caved in on privacy matters digitally and tax-wise to the United States, so it's lost its safe haven as well. How about the geopolitical reasons? Give me some of the bigger geopolitical reasons. For example, with China and New Zealand.
So Larry, this is the year of terror in the markets, and I think everyone's watching for where the next big terrorist event is going to occur. There are more than 1 million people on the U.S. terror watch list, and while the exact number in the UK is unknown, there was at least 3,000 extremists on the Jihadi John watch list. New Zealand, on the other hand, I don't want to say they're immune because no one's immune. That number, the number of terrorists on their watch list, is only 30 or 40. So they do not face the same threat that many other nations face. And I think that's very, very important because even in this political environment, they have less risk of terrorism and they're trading with Russia. They're getting ready to export to Iran, and they're actively trading with China and Switzerland. So we're looking at the geopolitical situation in the world. I think New Zealand is far more sheltered than many other nations.
Now, in contrast, Switzerland's position in Europe is making it increasingly difficult for the country to maintain neutrality. According to the head of Switzerland's military, the flood of refugees into Europe is turning the continent into essentially a civil war. Lieutenant General Andre Blattmann has issued a warning to the Swiss people that society is coming very dangerously close to civil war, and he advised them to be already armed as part of the Swiss Army Reserve and to take steps to prepare themselves. Now, the reason why Blattmann is so important because he was the head of armed forces since the 1st of March of 2009, and his words really carry significant weight in the country, in which already we see several citizens' initiatives against burqas, against mosques, and they've all proven to be extremely popular. Now, imagine something, Larry. As they get more anti-Islam in Switzerland, they become much bigger targets for ISIS. Switzerland has always been very, very neutral and has always enjoyed its protection from all the terrors of the world. But if ISIS decides to target Switzerland, you can be sure the Swiss franc is going to sink like a stone as a result of it.
I love it. I love it. I mean, there's the New Zealand, an island of safety. It's almost as if they're trading roles.
Yeah, exactly. It's like trading places in that movie. They've completely changed places. Exactly.
Exactly. New Zealand, safe, prosperous, growing, stable. Switzerland, in the middle of a European Union and an immigration situation that's going down the toilet. Beautiful contrast there. How about some topical reasons on, for example, China and the demand story there? We've heard a lot of negative news about China. I don't buy most of it, but I'd like to hear your reasons behind China and its relationship to New Zealand.
China is a very important story. And what I believe is that their economy is slowing down because they're engineering the slowdown. Last year, they announced their 5-year plan. These 5-year plans are very, very important because they played a significant role in shaping the way China has become and shaping their economy into the biggest growth story in the past couple of decades. Now, however, they're shifting their focus. They announced the greatest change in their 5-year plan they've had in decades last year. What they're doing is they're going to turn their economy from an export-dependent economy over to a consumption economy. And we believe that as China turns its back on the world in favor of stronger domestic growth because they realize they need this domestic consumption in order to become a sustainable long-term growth story, New Zealand will benefit significantly. And the primary reason is because New Zealand provides a significant amount of resources to China. One of the biggest stories we had at the end of last year was that China moved away from its single-child policy and they're moving to a two-child policy. So that means that every household in China, instead of only being allowed to have one child, can now have 2 children. What does that mean? That means that there's going to be more babies, and the more babies mean that there's going to be more need for infant dairy, infant milk. And New Zealand is one of the largest providers of infant dairy formula to China. And the Trans-Pacific Trade Partnership that New Zealand recently signed is also going to be extremely long-term positive for the economy. The whole milk powder prices are now pricing higher to 2,400 according to the futures prices, which indicates that Chinese demand is fairly solid, even though overall growth in China seems to be very weak. And in general, commodity prices outside of dairy have been tracking very well with the terms of trade index, and it has not lowered to the levels that the RBNZ expects them to. So that what that means is that the RBNZ had a lower forecast, the prices aren't as low, so the economy is probably going to benefit from the fact that it's not slowing as much as the Reserve Bank of New Zealand, which is the central bank of New Zealand, expects. But milk is not where it ends. New Zealand also provides sheep, beef, horticulture, and forestry exports. And China is a very big importer of New Zealand's beef products as well as beef feed. So we believe that between the infant milk formula as well as the meat products, as well as the meat feed, that all of these value-enhancing exports is really going to contribute to a major opportunity for New Zealand's economy when the rest of the world is just sitting there with nothing to do in times when China is slowing. New Zealand is really ripe with opportunity. Now, it's important to remember that New Zealand is a tiny economy. Its population, its GDP is less than where we're from, which is New York City. So even a small increase in demand of these key exports can have outsized gains on its economy, and it won't necessarily make New Zealand as vulnerable as many other countries around the world. China is the world's largest consumer market, so even a small bump in demand from China as a result of the rotation from exports over to consumption, we believe is going to smooth growth for the Kiwis.
That makes sense to me, everything that you said. I like the fact that it's such a small, politically stable country with such resources and such a great relationship with China. It's kind of like built-in leverage, as you said, because the GDP is so small, any bump up in the demand for New Zealand's products is like going to leverage the country's GDP and therefore its currency. What about, like, macroeconomically speaking, bigger picture speaking, with respect to China? Yes, I agree, they're turning towards domestic consumption. They have to. But lay out some macroeconomic reasons for me, for our audience, if you will, for the New Zealand dollar.
Well, China has a population of more than 1.3 billion, so we know that they are the largest consumer market, or one of the largest consumer markets in the world, and they're actually expected to be the largest consumers of food and beverages above the U.S. by 2018. So, this is really important because it means that, China, when they move their economy from exports to consumption, and the real key here, what we're trying to do is we're trying to position ourselves to benefit from the next big position that China wants to put themselves in the next 5 years. So they plan to drive consumer consumption, which means that they're going to be importing more food, and that's going to contribute significantly to the countries that provide that food, and we think New Zealand is going to be one of them. So going back to the data, according to Euromonitor, it is estimated that there's going to be significant growth in imports as a result of this two-child policy. I mean, just think about it. Under the one-child policy, dairy imports in China grew more than fourfold from 2008 to 2013. About half of those imports were milk powder used to manufacture infant formula and other milk products, while whey, which is the other half of it, or the other part of it, is used in various processed food and animal feeds. So if they move to a two-child policy, those numbers are just going to explode, and that explosion is going to benefit New Zealand significantly.
Now, Larry, while New Zealand is going to get all this benefit out of China's expansion into the consumer market, Switzerland is going to really suffer in 2016 because the strong Swiss franc is going to make it very, very difficult year for Swiss exporters. The Swiss central bank is doing everything in their power to talk down the currency, but because of the severe shortage of investment opportunities caused by negative interest rates, it's leading to a rise in very high-yield real estate investment. In other words, it's still attracting a lot of capital. And economists estimate that negative interest rates are actually creating incredible unintended consequences because they're providing around 1 billion Swiss francs of relief annually in the area of government spending, but point that they're also creating long-term risks in the funding of the retirement. And as you can imagine, all European societies, Switzerland included, is getting a huge demographic problem as the society gets older and they're going to need more resources. If they have negative interest rates, they're basically not providing any rate of return for their people, and that's going to create massive burden on the government budget. More spending, less money, very, very bad for the currency, and it's going to be a great contrast against the bloom of the New Zealand dollar.
So Larry, we put our brains together. I love the New Zealand dollar. Boris loves selling.
I hate the currency. I hate the Swiss franc.
He loves selling the Swiss franc. So we put together this trade, which we think is probably one of our favorite forecasts for this year, and that's the New Zealand Swiss franc.
Yeah, it makes sense to me. I mean, if I had to choose between those two countries where I would want to live and take my money with me, I would certainly choose to live and invest my money in New Zealand, certainly not Switzerland. So what you're saying is go long the New Zealand dollar and short the Swiss franc. Tell me how what your forecast is for that trade.
Yes, our research suggests that the New Zealand dollar should rise to at least 79 cents against the Swiss franc. So, in terms of how you can look at this trade, right now, for example, you can buy an investment designed to soar as the New Zealand dollar soars against the Swiss franc for as little as $67 plus commission. If the New Zealand dollar rises to 79 cents against the Swiss franc, as we predict, you could walk away with a 435% pre-commission profit.
Or, Larry, you could use another similar but more aggressive investment, also selling for about $67, and have the potential to bank as much as 881% when the New Zealand dollar explodes. And we found another position selling for about the same price with the potential to hand you a gain of 1,587%. Now, granted, there are risks involved in every trade, but that's enough to turn $10,000 initial investment into nearly $170,000 in 2016. That is the kind of trade opportunity we love to take a participation in.
Yeah, home runs like that, they can and they do happen. They don't happen all the time. There's risk associated, but I know you guys and how you trade, and judiciously you trade, and then every now and then you see an opportunity like this, you go for a home run or a grand slam. I totally agree with your analysis, and it's clear that trading the New Zealand dollar is the best way to play this situation, while shorting the Swiss is the best way to take advantage of a currency that's really going to be sinking rapidly. And the fact that you can play this more conservatively with an ETF, for example, or go pedal to the metal with options is great. I love that flexibility. I can't deny that the potential to grab a quick triple-digit gain with options is always a thrill. I've done it for my subscribers. They love it. I've done it for myself.
I was going to say, Larry, we have a lot of conviction on this trade, and we hope to achieve exactly the kind of returns that you've been able to get for your subscribers last year with it.
Well, that's awesome. If you want to receive all of Kathy and Boris's specific buy and sell signals for 2016, be sure to click the button below this screen. It will take you to a page with details on how you can have our guests' trading signals delivered directly to your inbox. Thank you once again, Boris and Kathy, for your insights today. I consider them exceptional and logical.
Thank you, Larry. It's been great to be with you.
Thank you for having us.
This is Larry Edelson for Weiss Research. Thank you for watching today.